So thank you, Eric, for taking the time and to chat with us today. Maybe what we could do to kick off, since there could be parts of our audience that maybe are not as well acquainted with you, but maybe we could kick off with just a little bit about your background and how you got to where you are today. I'm sure you'll take us on a little bit of a journey through your time as an executive and an investor, and then what you're currently doing with Lerer Hippeau.
Sure. I don't know how far you want to go back, but let's go back to go back further if you want. But in the 1990s, I was the CEO of a company called Ziff-Davis, and we published all the big computer magazines, so PC Magazine, Computer Shopper, PC Week. We also owned all the big trade shows like Comdex, Network Plus Interop. We had market research, so we were kind of a full-service media marketing services company that exclusively served the technology industry. So we thought of ourselves as being in the tech world, and as I said, we organized some of the best conferences in the business. But I never went, none of my colleagues ever participated in anything that had to do with media. We never went to media conferences. We didn't know anybody else at Condé Nast or Hearst or NBC. Mm-hmm. We were strictly focused on the technology industry, and we grew up with the personal computer. So that's why most of our magazines were PC Magazine, PC Week, etc. So it was at a time of tremendous innovation and tremendous growth. Mm-hmm. In many ways, it was pre-internet, so we were kind of the main conduit for product from this growing industry to consumers. We ran labs, so we had a big lab right in Manhattan on Park Avenue and 33rd Street called PC Labs, and we literally had engineers, people in white coats, and we would take in all kinds of products, and we would test them, and we would rate them, and it was done editorially, so it was completely independent. And if you got a PC Magazine editor's choice, you kind of were off to the races. So among the products that we were the first to pay attention to and to review were kind of the direct mail, the direct order computers. So Dell, Gateway, companies like that we really grew because of our because we gave them, we compared them to an IBM computer or an HP or some of the Japanese computers that came afterwards, and we many times considered them to be superior. So we gave them the PC Magazine editor's choice, and they kind of took off, and that's how the direct marketing industry really got started. Mm-hmm. And then we grew up with Bill Gates and Steve Jobs. We also published the main magazines in the Mac world, Mac User and Mac Week. And then we had PC computing, PC gaming magazine. So we had the whole thing. When I was first CEO, the company belonged to the Ziff family. Mm-hmm. And the Ziff family decided to sell the business. So I was tasked with organizing it to be sold. And we sold the bulk. We sold it in bits and pieces, but the bulk of it, at first we sold to a private equity firm, Forsman Little, mm-hmm. and then we had sold our trade show business to SoftBank, and SoftBank in parallel had bought Comdex, so that made sense for them to kind of like have all the trade shows. Forsman Little did not care about the trade shows, so we sold them the magazine business and some other things, and we all stayed on. And then 10 months after that, we finally sold the business to SoftBank. So SoftBank owned Ziff-Davis, and we put everything back together, all the trade shows, all the magazines, and everything. Eventually took that business public. We took our internet business, ZDNet, public separately. It was in the days of the tracking stocks. Mm-hmm. And in the late 1990s, we sold everything off because SoftBank wanted to refocus their efforts on building a nationwide broadband network in Japan. And so we repatriated the proceeds from most of the holdings that they had in the U.S. We sold Ziff-Davis, we sold a lot of our shares in Yahoo, E-Trade, a bunch of companies, and that helped them build this network. When we finally sold everything off, I joined SoftBank Capital as a general partner and opened the New York office. So now, just to go back on one point, so when we were about to sell the business to SoftBank, we were also, as Ziff-Davis, we were also about to make an investment in Yahoo. So I had struck an agreement with Jerry Yang and TK, who was the CEO at the time, that we would invest $5 million. This is way pre-IPO for the company, and it was a way for us to be more intimately involved with this new thing called the web. And it was a way for them to have a tech-based media company kind of helping them out with content and organizing the content and all this. But just as we were about to paper this agreement, we sold the business to SoftBank. And long story short, Masayoshi-san liked Yahoo so much that we struck a deal that we would own a third of Yahoo at the IPO, whatever the price was. It turned out to be $112 million. And then also we struck a deal to start Yahoo Japan, which only required, at the end of the day, $2 million of investments, and became a company worth $35 billion. Right. So that kind of kick-started some of the investments that SoftBank was making or started to make in the U.S. Some of the early investments really came out of the deal flow that was naturally occurring as a result of Ziff-Davis. So companies like US Web, or Yahoo, US Web, GeoCities, and others were investments that SoftBank did directly out of their treasury, and then they formed the SoftBank Technology Ventures funds. Then that became Mobius towards the end of the 1990s, and then I joined. I opened the New York office, and eventually I led the Series A in the Huffington Post and met my partners, Kenny Lerer, his son Ben, and I became the CEO. I liked the company so much that I became the CEO a couple of years before we sold it to AOL. And then so at that time, New York was going through a real boom in technology startups, having to do with some major trends, what we would call the urbanization of tech, where you've seen this was the beginning of, you saw the migration of tech workers from Silicon Valley to San Francisco. Suddenly, younger people want to live in a dense urban area, and New York is the largest urban area in the country, and with a lot of different things to do, diversity and whatever you want to do, you can find it in New York. So people love living here, and it made possible by the fact that technology had gone to the cloud, or was starting to go to the cloud, and that you could have access to the same platform, same tools, same everything that engineers or developers had in Silicon Valley. You could be anywhere in the world. So New York kind of matched the best of both worlds, and there was a lot of really exciting activity going on in startups. So we decided to, because we're well known in New York, we had all these opportunities to invest. Rather than do it individually, we grouped our efforts, and we started it was a side project, a small fund. That was it was actually not called. It was called Lerer Hippeau Ventures, and that became our first fund. And it was $8.5 million, and we were acting more like angels. So we would do 50, 75, maybe the tops $100,000 investments. And then so that was 2010, and in 2011 we sold. Early in 2011 we sold the Huffington Post, and we decided then to do this full time. So today we're investing Fund 5. So that's kind of the quick progression.
Okay, that's great. Very very helpful. You've obviously seen a lot. One of the accomplished a lot. Just a quick note. Some of our audience members, folks who read our blog, are families who traditionally have made their wealth in what I'll term old economy businesses, and they've tended to stick more with that line of focus and investing. But when you start to see in the media these big funds, such as SoftBank's latest Vision Fund, 100 billion, and that could be a sequential thing. Are there, maybe a couple things to point out about, why this is important, private investing in technology, why maybe some of these families should consider, thinking about these segments of the broader economy, more so than just your, diversification through public equities or other similar types of investments that are available?
It might be hard to generalize, but in essence, all segments of the economy are being affected and disrupted by technology. So investing in technology today, it used to be that you would invest in, a software stack or a modem or something that was you could recognize as that's technology. I can recognize that, and we still do that. But in many ways, we invest in technology-driven businesses that are disruptors. So as an example, so half of our company is enterprise software. So the SaaS model is really kind of the PC of today. So the PC, at first, if you remember, people thought of the PC as a consumer product, and it turned out that that what made the PC was a business product. So that people saw in the PC their ability to finally have computing power, whereby they had to wait in line with their IT department, and if they weren't important or weren't for some reason funded, they would never get anything done. But so they started to bring in these PCs and doing tremendous work, and the levels of productivity increased tremendously, and that was a big factor. But today, software as a service, the cloud-based services that you can find are disrupting every mode of computers and giving enormous power of computers. If you run on Amazon Web Services, you have on your tablet, on your phone, you have access to a supercomputer that you would never have imagined. NASA wouldn't have imagined having that even 10 years ago. So that's on the enterprise side. But on the consumer side, technology is driving pretty much anything you can imagine in terms of innovation in sectors like mattresses, eyeglasses, shoes, you name it. So we have a bunch of companies that Warby Parker in eyeglasses, Casper in mattresses, Allbirds in shoes, Glossier in makeup, Lola in women's health products. You name it. There is a technology-driven company, or will be a technology-driven company, that will completely change the rules of the game. And it will be a direct-to-consumer company that will have a lot of data about their consumers, and very, very disruptive, not only to the retailers, because as you can see in New York City, pretty much every retailer, we just learned today that WeWork is buying the Lord & Taylor headquarters to make into their headquarters. So there goes the department store. It's going to be gone.
Right.
And it's going to be very hard to find retailers going forward. But obviously it affects the people who make the products that sell into retail. So that's for kind of the retail. But anybody who has products that go into distribution, into wholesale, pretty much anybody who's made their family, whose fortune was made in those sectors, in my view, should think about investing in disruptors,
right,
in their industries, because they know their industry, and it makes them participate in a lot of wealth creation, and they might be able to be helpful too.
Right. And what do you look for when you're, I know there's probably a long form answer to this, but if we could boil it down to when you're deciding on a potential investment opportunity, or meeting with an entrepreneur or a management team, what are kind of the key characteristics that you're looking for? And I guess it could be, the person or team themselves, and it could also be macro driven, or a combination of the both.
It always starts with two things. One is the idea. So does the idea resonate? Does it feel plausible? Does it feel that the levels of technology today are able to do what those people want to do? Is there going to be a big market? So it can't be, obviously we're early stage investors, so we have to invest in big ideas. Mm-hmm. So that's the first thing. The second thing is, which is hard to quantify, but really important, is timing. As an example, in the late 90s, kind of early 2000s, late 90s, there was a number of companies that got funded to do video sharing. And they pretty much all disappeared because the projections about broadband adoption in the United States were way too optimistic. And it took literally 4 or 5 years more. And then eventually, two friends developed an application that became YouTube to essentially share videos among themselves. It wasn't meant to be commercial, it was just kind of like a hack. They were doing that. But it turned out that the timing was perfect because there was now critical mass. They didn't realize that, of course, but there was critical mass in terms of broadband deployment, and people could easily, or not as easy as today, but more easily share videos, which require a lot of space and a lot of broadband, etc. And that's when YouTube took off. YouTube wasn't the best technology application in that field. It just happened to be the right idea, right time, and the right people. So timing is really critical. If you invest too late, you're investing in a Me Too. So look at the mattress business, right? So there's a lot of copycats of Casper, direct to consumer mattresses. But most people would be hard pressed to recognize anyone's name except Casper. Mm-hmm. So if you invested in the guys behind Casper, you might still be okay, but it would be better to invest in Casper in this case. So too late is also not a good idea. You can't, this comes out of just seeing, we literally see 2,000 companies a year. So it comes out of just seeing a lot of stuff over many years, and then you start to, we're not always right. But you get to a better sense as to whether the timing could be right. So once you feel somewhat comfortable that timing is right, then the main focus is going to be on the founders and the people who are going to be doing the business, and who are they, and why do they think, what's motivating them, right? Is it a visceral wow, I know there's a need because I have felt it myself, or I could see people around me needing something like this, and it becomes more of a mission on their part, and as opposed to people who say, well, I want to be an entrepreneur, and let me study a few markets, and I'll come up with some ideas, and I don't really care if it's in healthcare or automobiles, or that to us is not the right founder. We want the founder who is viscerally committed because it's going to be tough, and we want someone who's going to be resilient and not take no when there's a challenge. And by the way, it's always, unless it's a repeat entrepreneur, we only invest in teams, and one of the members of the team has to be an engineer or a tech person. So we spend a lot of time figuring out who they are. We vet them through our network, we will pass on people we don't think will stick around, or for whatever reason, and of course we study the business plan, and we look at the presentation, but all of that is more indicative of how they think, right, and whether we think that they know how to build will the margins be sufficient to support an organization, and those kinds of things. But we're not looking at absolute numbers. These are startups,
Yeah.
right? So we're not going to go back and say, hey, you told us you were going to do X and we only did Y and bad people or whatever. That would not work.
Right. A couple things. Want to spend a little bit of time talking about direct-to-consumer. You mentioned it. You've invested well in that. Along those lines, and then media, because that's your, I guess, kind of where you really kind of accelerated through. So, the e-commerce. Whenever someone thinks about direct-to-consumer or e-commerce, they think Amazon, and Amazon obviously is the behemoth. But what some people may fail to recognize is that that's a small fraction of the overall direct-to-consumer universe, where you have over $1 trillion being spent annually online, and arguably Amazon is 10% or less than 10% of that.
Yeah, but sorry to interrupt, but we would never invest in the retail business. So if they're not producing their own brand, or if they're not producing their own goods under their own brand, we won't invest, because that you can't compete with Amazon.
Right.
If you're just reselling other people's products, Amazon will undercut you any day. So what's the point of that?
Well,
of course, there's Jet.
Yeah.
And good for them. But they were very fortunate that Walmart, at exactly the right time, needed. I didn't invest in Jet, but I would be shocked if they had predicted that they would sell to Walmart within 2 years or whatever it was.
What about specialized e-commerce? Meaning, if you have the buyer experience is important, and so you have a luxury brand, and they want to control kind of how their brand is perceived, and then that's a fairly sizable segment of the market. Do you see anything in that area that's interesting, away from, I guess, the direct-to-consumer experience that is mass marketed with an Amazon? Are there any kind of innovative things happening outside of that?
Well, yeah, the direct-to-consumer category has invented or reinvented in some cases using technology. For instance, a Stitch Fix is going to go public, and we have a company called Dia, which serves, it's an apparel company that serves the plus-size women marketplace. And that model is you have a box, and with data you adjust the product that you send monthly in that box, so that you're trying to accommodate, you're trying to figure out what's going to please the consumer or the subscriber, and then that person will try different pieces, and will only pay for those that he or she keeps, and then send back the rest. That model is only made really possible with lots of data, because just the sheer cost of producing that box and shipping, even though the shipping costs aren't that huge, but shipping product that you might not get paid for requires you need to have a good hit rate. You've got to get people are actually going to like what they have. You can't do this without data. So a retail store couldn't do that.
Right.
So that's just it's probably not. I'm sure that it's a rehash of some other model that has existed in the past, but it's really made possible because of technology.
Yeah, it's interesting. Like, what do Lord & Taylor, for example, they're obviously hurting a lot of these department stores. Overall, you walk at the malls, traffic is down. Certain malls, that's not every mall.
Yeah.
But how do those people survive? How does a traditional brick and mortar retailer survive? I know that's a different question than the consumer product.
Yeah, so a lot of them are thinking about this, and we just sold a company called Plated to Albertsons, and Albertsons is the second largest grocer in the United States. I think they have 3,400 stores. They own Safeway, other brands, and so they're thinking through, right? They have this huge, and they're very dominant on the west coast, kind of Rockies and mountains and west, and so they're thinking through, what do we do? We don't want to give up our locations. There's traffic, etc. But the locations could also be used as mini warehouses. They could also be used for home delivery. Particular fresh products. Why so there's other things that you can do with your physical location that if you had the data and if you had a direct-to-consumer offering. So in the case of Plated, they could have a Safeway meal kit, for instance, that you could either pick up at the store or you can have the store deliver directly to you. So that is an example of how some people are thinking about reinventing. And I think everyone who has, particularly those people who have chains, like in the food business, delivery has become a major driver of revenues, right? So again, single location, it's open to the public, but it's, in many ways acts like a commissary. So I am actually a big believer, and you see some of my companies are going the other way. They're opening stores. Warby Parker has over 20 stores. Allbirds just opened a store right here on Prince. And so there's a class of people, category of people who will not buy it. They don't touch it if they don't see it. If they don't get the look and feel. So you need to address those people. Now, in some cases, like in the case of Warby Parker, they're not going to keep inventory in those stores. They're going to be like showrooms, and try on whatever glasses. You go, you order them, and they ship them to you, so that they don't have those extra costs of keeping inventory, particularly since they have such a wide range of product.
Got it.
It would be difficult.
Yeah. Switching gears a little bit to media, obviously it's a completely different time today than it was when when you were first maybe starting to talk about computers, PCs, and all the different type of information that's relevant for readers. And now we're kind of all on digital media. What do you think the game is today? You were at maybe it was timing too to be in that subject matter, and to be bringing it forth, and everything was print copy. Today it's all digital. I guess what are the strategies for a media business if you were to start it focused on a certain topic, but what are the kind of the key tools to having that be successful today versus when years ago? Well,
today, not only is it very different from years ago, it's actually very different from just a couple of years ago. So everything is changing so rapidly. And the differences today are that it's largely driven by distributed content. So it would be, I would say, there's always exceptions, but quasi-impossible to start a website today. It's like, say, if somebody came here and said, I'm going to launch a magazine, I would laugh at them. Or a cable channel for that matter. Right? So, great, good luck.
Yeah.
So just in a matter of a few years, the main distribution comes from the social media sites, with all the issues and controversies that we're learning about today. So that's one. Second thing is that in order to be successful in distributed content, you really have to master video. Video is tough. Video is expensive. A lot of organizations just don't have that in their DNA, and are having a hard time moving to video. Video is changing rapidly. So video, some of our BuzzFeed, Dodo, NowThis, which is a leader in short-form video news on the social media, their formats keep changing depending on what they read in the data, right? So 15 seconds, 20 seconds, there's a huge difference between someone who will complete the viewing on a 20-second video as opposed to a 15-second video. Now, is it across the board, or is it certain types of video? So you have to constantly read the data and then do more of the things that work, do less of the things that don't work. And then you have to have a big experimental program. So you have to try 2 minutes videos. You have to try mini-series, and maybe every episode is 5 minutes. BuzzFeed is doing a morning TV show on Twitter that seems to be doing great. Whatever exists today is probably unlikely to survive tomorrow. So you constantly have to change, and that is not traditionally the way a media company thinks. A media company is essentially in the business of creating content, and the distribution in the old days, until a few years ago, was very stable, right? And now it's very unstable. And so the most successful companies are the ones that are, adapting to those changes. And that's why we're well known for our media companies, because of the Huffington Post, BuzzFeed, Mike, Axios today, which is our newest, very successful media company,
right,
which happens to publish in an old format, which is newsletters, electronic newsletters. So some of the old formats still work for certain applications. In this case, Axios specializes in first thing to know in the morning, from the White House in tech and energy, whatever. The newsletter is the most efficient way to deliver that to your mailbox, and they call it smart brevity, etc. But they're also going to experiment with video. So we are very selective today, because it takes a special kind of founder in the media business to really embrace this constant change that's going on.
Right. Maybe I really appreciate all the time you've taken.
Sure.
If I could ask one more question.
Yeah.
Maybe just what's most exciting to you today? Like what areas of I know within your firm you focus on a specific set of areas, but I guess what gets you most excited? What technologies? What types of companies?
Well, we are obviously, we have our points of view, but we are also the majority by design. The majority of our companies are in New York. So we are kind of representative of what New York is good at, and the four main quadrants that have existed in New York since we started to invest are enterprise software, media, direct-to-consumer, e-commerce, and then generally consumer products. Right? That is, in every fund we found great companies in these four quadrants, and then with every fund there are kind of new trends that some of them either continue on or it's just a moment in time. In the previous fund, we had a nice concentration of companies in the food technology area. We're still very much interested in food. Companies like Soylent, etc. We're still very much interested in food, but we're not doing as much today because we're not finding as much new companies that we like. Today, we're starting to make investments in robotics. Paradoxically, it's interesting that New York is becoming not the largest center of innovation in robotics, but a good sizable center of innovation. And it's got to do with robotics. To me, it reminds me of the mainframe days in computing. So pre-PCs, it was these mainframes, and there was four basic companies. You had Univac and Burroughs and IBM and whoever else. And the hardware, the computers were massive, and they were very expensive, very hard to program. You needed real specialists to program them. And if you look at the robots today, the ones that the most common ones would be the robotic arms in the auto industry. They're manufactured. There's four companies in the world that manufacture those. There's two Japanese companies and two German companies. So very much like the mainframe days. And akin to the mainframe days, these are very expensive. They're upward of $100,000, and it's very difficult to program. They're like, you need some specialist from Germany to come and reprogram your robot. But because of the world of 3D printers, and we were early investors in MakerBot, so there's a community here in New York that grew up creating 3D printers, and there's now a supply chain of components that are really commoditized that can also be utilized for robotics. So the price of robots is massively coming down, and the value, and we were never hardware investors anyway, because we don't really want to be in the hardware business. We want to be in the software business. So the value of these new robots is accruing to the software layers. They're building robots that are easy to program, that you as a user can learn how to program. They're based on common technology in the cloud again. So as an example, we have a company that sells robots to automate labs. Stanford has 6, MIT has 7, they sell about 25 robots a month, and they're still a seed-level company. And each robot is about $5,000 and can do the work of, a couple people, basically. So it's not in their case, they're not trying to replace the workforce. The workforce can be retrained to handle the robots, do other things. It's just that when certain functions, like in the lab work, you're moving a lot of liquids from one pipette to another. It's mostly done manually, and the error rate is huge, and that can have massive repercussions. So with a robot, you're just these rote operations can be completely made automatic, and that, as I said, the person who used to do that, you can train to handle the robots or whatever.
Right.
So, but here what we're seeing is the opportunity is that this massive price, decrease is a major, in our mind, investment opportunity. So that's a trend of the moment.
Yeah.
Don't know if how long it's going to last, but we're doing that.
Right. Fascinating. Well, I think that about concludes it. Did you have anything, Peter?
No.
No.
It's very helpful.
Good.
Yeah.
Great.
Okay.
Great. Nice to meet
Thanks so
you.
much for your time.
Yeah,